First, a panelist is Simon Johnson, who is a professor at MIT, and he will be, or he is, joined by Thomas Philippon, who is a professor at NYU. And both of them obviously are very well known for their, not just their academic work, but also their public writings and their policy writings. But at the same time, both of them have recently written very influential books on the question of investment and on the question of what should be done about this particular problem. Simon in particular has focused on, with Jonathan Gruber, has focused on Jumpstarting America. That's the name of the book. And it's a wonderful book. I had a fun time reading it and underlining many parts of it. I think it's really a fascinating conversation and a very important conversation. It's really about, as the title says, Jumpstarting America. One of the basic facts about the US economy is that there has been this continual decline in public investment spending. While public spending overall has remained constant, more and more of it as a share is going to transfers and less towards investment of all sorts. And that's very much connected to what Mariana was talking about earlier as well, that the US is used to do stuff that it's not doing again. So that's going to be a common thread that I hope Simon will pick on as well, and he'll mention some of the things that he has done. Thomas Philippon, also, as I was going to say, has a brilliant new book that has been critically acclaimed by many. He talks about, in particular, focuses more on the private side of this investment problem. And Thomas talks about, in particular, the rise in market power, the rise in concentration. And there we go. That's the book right there, The Great Reversal. And Thomas in particular, again, I had a great time reading his book as well. It talks about the question of market power or concentration in private markets, and how it came about and what can be done to limit or reduce the extent of market power in the private sector. And one question that I'm going to ask him is whether that has played a serious role in hindering investment. And just to connect to some numbers that Mariana showed early on, if you look at the US corporate sector, as Mariana showed as well, it's investing back into the real economy a lot less proportionately, and a lot more is going back as profits to the shareholders, whether it's in the form of dividends or buybacks. And so it looks like, and it's not like they are short of cash. The other main fact that Mariana mentioned is that the profit share is rising, and it's bigger than it has ever been in a sense. And yet we don't find the private corporate sector to be making as much of real investments as they used to in earlier decades. So that's a big question, as I said, both from the public and the private side. That's the topic of our conversation. I will leave the floor now to the two panelists. What we will do is we will first give time to each of them to give their opening remarks. And then in the meanwhile, everyone on the call, please give us your questions, and I will channel those questions back to the two panelists. So let me start with Simon Johnson, and then we'll move over to Thomas. Simon.
Thanks, Atif. I think I might logically go after Tom. I'm not going to object to going first, but I think that our book is very focused on proposing a particular solution, focused on boosting public investment in R&D, because quite consistent actually with what Mariana was just arguing, during and after World War II, the US invested a lot, up to 2% of GDP at its maximum, in, let's call it general science and also technology, then with a lot of spillover effects. And this did have all kinds of sectors. Mariana went through them, from computers to satellites and others. And my internet connection is warning me it's unstable, in which case I'll dial back in and do this over the phone. But I think that we lost, Atif. And again, it's an interesting question. I saw some really good commentary in the Q&A sort of pushing a little bit on, if the space program was so successful, and I do agree it represented, symbolically at least, that the peak of this effort, why did we give it up? Why don't we do this anymore? We've fallen from about 2% of GDP to 0.6, 0.7% of GDP public R&D. And in our view, and I think this is complementary to Thomas's perspective, this public R&D would be good in its own way. It would stimulate more new opportunity that the private sector would either grasp or not. To grasp the new opportunity, Atif, I think you have to invest. And preferably you would be investing in the United States. So we have some things to say about that. We also think, and I just want to, and I know it's not your primary focus here, but emphasize that we think left to its own devices, and this is related to Thomas's market concentration ideas too, a lot of innovation has ended up right now on the East and West coasts with a degree of concentration that is pretty much unprecedented in US history. And there are some pretty good reasons for this in terms of pure market logic, but it's not a very good broader social outcome. And it does lead to a loss, a lot of missed opportunity, a lot of talented people who don't get to participate fully in the innovation economy. We could talk about the evidence for that and why that may be. So if you're going to make a big push on public support for R&D, you're going to do that to help push the private sector towards more competition, more investment, and more job creation. Let's spread that around the country. And I think to Mariana's point also, let's take some lessons from the private sector in terms of how you structure this. So the famous Amazon HQ2 competition, which basically every urban area in the United States tried to bid for, it was a little bit crazy, a little bit out of control, a little bit pointless, maybe in some ways. But on the other hand, it did push people to articulate the case for investing locally, that they brought a lot of stakeholders to the table. I know at least one place where they reorganized and brought in stronger higher education assets to their region. And before they knew the outcome of the Amazon process, they said, hey, you know what, we should be doing this anyway. This makes sense to integrate higher education, private sector, and job creation. So I think pushing to provide funding for these hubs in a competitive basis, in a way that is hopefully less prone to capture. Atif, I heard you prodding Mariana in that direction. Very important concern. So can we deploy the public R&D? Can we stimulate private investment? Can we do it in a way that encourages places to participate? Places like Rochester, New York, or Nashville, Tennessee, or many other places. We have a list of over 100 plausible places. Can we spread that innovative community and innovative spirit around the country and create something similar, much closer to what we had before in the 1940s, 50s, and into the 1960s. So that's the point of our book, that's our proposal, and that's, in a sense, an attempted solution. Of course, if the private sector can take care of it by itself, the private sector can generate more good jobs through investment and just general expansion, we have less of a problem. But maybe I turn it now over to Thomas, because I don't think that's where the private sector is heading, left to its own devices.
Thanks, Simon. A number of points you mentioned we will come back to, but let's hear from Thomas and then we'll engage in a conversation.
Good morning, I guess good afternoon, everybody. And you see, I had to go and run back to get my book. I'm not a pro like Simon. My publisher always makes fun of me that I never show the cover of the book because I just never have it with me. So thanks for reminding me. So it's a pleasure to be with you. I just want to show you 3 or 4 figures just to set the stage and talk about private investment. So I think that was mentioned earlier, if you look at corporate profits as a share of GDP, it's very high. Now, just by the way, as an aside here, if you look at profit rates of companies, they were also quite high in the 1960s. So on a pre-tax basis, profits are high today. They were also somewhat high in the 60s. The big difference is corporate taxes were much higher. So after-tax profits are definitely at an all-time high. So you can see it on this figure. Okay, so it's like from 6% to 10%. That's a huge increase. So this is after-tax. Pre-tax, it's still high, but it's not as striking. The thing that is puzzling for economists is that when firms make a lot of money and their funding costs are low, then two things should happen. One is, of course, that their assets should be highly valued, and they are, but also they should be trying to replicate these assets. You know, if I tell you something is extremely successful, and here is a lot of money to do the same thing and make even more, then why don't you do more? And that's investment, of course. And the puzzle there is that investment is relatively low. So if you take a look at net investment as a share of net operating surplus, went from about it went from roughly 1/3 to 20%. Okay, so a third, that meant that out of every dollar of net operating surplus that the corporate sector generated, it would plow back about 1/3 to 33 cents as capex, as net investment. And today it's less than 20 cents on the dollar. So this is the puzzle. That's the issue that we're facing. Now, so what you can look at it in the cash flow space, you can look at it in the asset price space. In the asset price space, one market, of course, that capitalizes profits and discounting is the stock market. So we have a theory in economics that links the value of assets using stock markets to the incentive to invest. And it worked. So the measure, the summary measure, is named after Jim Tobin, the very well-known Nobel Prize winning economist from Yale. And so he has a measure which moves around, which is the ratio of the stock value of asset relative to the replacement cost. And when it's high, you should see a lot of investment. And you can see, like in the 1990s, Tobin was rising and the investment was rising, then it falls. And then here, what you see in the post-2000 period is, of course, there is still correlation. So for instance, in the great financial crisis, we have a sharp drop in asset valuation and a sharp drop in investment. But there's a persistent gap that appears. So they do fluctuate together. It's just that investment is debased lower. So this is the same puzzle as we saw earlier. Is the fact that firms are making money, funding costs are low, therefore asset values are high, but the firms do not take advantage of these conditions to increase their investment. And if you accumulate this gap here, you end up with a shortfall for the net private capital stock around 10%. Okay, so in other words, if firms had continued to invest according to what they had done historically, then the private capital stock would be something like 10% higher. Now, at the same period of time, perhaps by coincidence, we see a sharp rise in concentration in many industries. Okay, so this is the green line here is the cumulative gap from that figure, taking into account, of course, depreciation. So that's why you see at the end, 2015, here I'm like about 12% below where we should be. So that's my point, that the aggregate capital stock might be 10, 12% too low. And this gap start to grow in 2000, exactly at the same time as we see the rise in concentration in manufacturing and non-manufacturing sector and the rise of the profit margin. And part of the book is trying to argue that this is more than a coincidence. And maybe one way to just launch the debate is that not every industry in the US has become very concentrated. Okay, there's a wide range of outcomes. It turns out that also not every industry shows a negative investment gap. More interestingly, the investment gap is exclusively coming from industries that have become more concentrated. Okay, so that's what you see here. So this is the same data as before. And this cumulative gap, now what I do is I split industries by the ones that have low concentration or low changes in concentration, and the ones that have a high increase in concentration. So so that's like the top 10% of industries that have, the top 10 industries in terms of concentration are in green. The bottom 10 are in red. It looks like actually the bottom 10 in the US, turns out their concentration is kind of constant, slightly falling, while the top 10 have a very sharp increase in concentration. And if you run for this...
Thomas, did the chart advance? I think I'm looking at the same chart.
Yeah, I was going to ask the same question to we are still seeing your older chart that investment is low relative to Q. You're not seeing the new one that you're referencing.
All right, so then let me try to share again. Sometimes it happens on Zoom. Okay. So you were seeing this one?
Not yet.
It's still blank, but I think it's trying to share.
Well, I can say it anyway with words. I'm going to flip to the...
Right, so now we are not seeing anything. We're just seeing a black. Oh, okay, now we see it. Go ahead, now we see it. So we see two panels, right and left.
Yes, so there's the one with concentration, and then the last one is also, that's the one where there's two panels. On the left, you have the Herfindahl index. And on, okay, good. Okay, so this one is showing you, all I do is I break down this lack of investment across industries, but I don't do it randomly. I sort industries according to which one have become more concentrated. And so I look at the top 10 industries where concentration has gone up the most, and these are the green ones. So see the green lines going up. And then the bottom 10 are the 10 industries where concentration has gone down the least, gone up the least. It turns out that it's kind of flat, slightly decreasing. And then for each industry, then I look at their investment residual separately. And what you can see on the right panel is that for industries where concentration has either not changed or maybe declined slightly, there is no investment gap. Okay. In other words, these industries look like they are investing just like they were in the past. They follow Q theory, or they follow the reinvestment of cash flows just like before. But if you look at industries where concentration has increased a lot, this is where you see the investment gap. And remember that on average, the investment gap for the whole economy was around 10%, but it's not 10% uniform. It's actually 0% for industries that have remained not too concentrated. And it's about 20% for the ones that have become very concentrated. So on average, you get 10%. So this is that's kind of a hint that perhaps the rise in concentration and the relative decline in investment are connected. Okay, they don't happen randomly. And so then the book goes through a bunch of cases for why the two might be connected. Now, broadly speaking, and then I want to conclude, I don't want to be too long. Broadly speaking, you have two classes of explanation, and both are valid. And part of the game is to figure out when is it that one is more important than the other. The first class of explanation is obviously that investment is hard to measure, and some of it is intangible. And if we have industries that are going through rapid changes and they use more and more intangible capital, and we measure it poorly, then we're going to miss a bunch of intangible investment in the data. If it's also the same industries that are growing more concentrated, perhaps because intangible capital has lower decreasing returns, probably well, to scale or to scope, it's kind of the same in this case. So if you're good at intangible investment, you can essentially run a much larger firm, which I think there's evidence for that. Then you would explain why in some industries, there's a lot of relatively high intangible investment, relatively high concentration, and would mismeasure. So that's kind of one class of explanation. And we know it's part of it is true. There's no question. We also know there's an upper bound to what it can explain, because even if we look at parts of intangible investment, which is actually well measured, even that has gone down. So we know that the intangible story cannot be the full story, but we also know that it is part of it. Okay. The other class is that, well, there's a reason why firms don't want to invest, and it could just be that they have more market power. And there, if firms are market power, then naturally their incentive to invest are lower than they would be otherwise, for two reasons. The first one is like the static monopoly issue, which is if you have lots of market power, you don't want to waste it, and so you just restrict supply. Okay, that's kind of Econ 101. There's a more interesting and a dynamic story, which is part of the reason firms invest is because they want to keep ahead of the competition. So they run faster just to stay number one or number two. But of course, if nobody is barking at your heels, your incentive to keep running faster are lower. So what do? Optimally, you relax. In the case of an investment strategy, you switch to paying out more dividends. And it's perfectly fine for firms to do that in the sense that they are doing the right thing for their shareholders. There's nothing wrong with their governance or anything. It's just that in the end, for the aggregate market, it's not the right outcome. Okay. And so what I show in the book is both are true, but definitely you can make the case that part of what we see is lack of competition that has a negative impact on investment. And what's important is that's above and beyond any harm to consumers. Like monopolies are bad because they charge higher prices, that's for sure, irrespective of their investment behavior. But on top of it, if you have this negative impact on investment, then it accumulates.
Atif, can I suggest, and Thomas also, an example that may link some of what Thomas is saying with what we're saying, John Gruber and I, which is about universities. When I first came to the US in the mid-1980s, there was, or compared with when I first came in the mid-1980s, the population of the United States has increased by 100 million. What has been the increase in the number of students enrolled in, let's say, Ivy League plus MIT? I want to be fair about this. Ivy League plus MIT, body of undergraduates, is about the same since the mid-1980s. And now, I think this is related to Thomas's snapping at your heels thing, right? Which is, why doesn't MIT become twice as big, or Princeton, or other? Because they have a good market position. There is, don't get me wrong, there's plenty of really good universities out there, and some of them expanded a lot, including engineering schools. But it's not the same as the transformation we saw of higher education between 1940 and 1970, for example, where there was a lot of federal money to compete for. There was a lot of expansion. The enrollments increased massively, tenfold, perhaps overall to about top engineering and science programs. And I think, Thomas, that this is a link. So universities are not profit maximizing, right, in the same way, but they are responding to competitive pressures. And how would you get them to expand or push or be more aggressive? I don't know, but we could get more top level universities to expand and to add to that mix, and at least to stay up with the size of our population.
Yeah, I mean, I think the academic market is a perfect example of a market with high barriers to entry. It's extremely difficult to create. I mean, pretty much the only full success story of something that did not exist. I mean, Stanford is one of them, but it's still old now, and so it's extremely hard to make it to the top 10 or top 20. And so that means if you are in the top 10 or top 20, you're going to compete with your peers, but you're going to, your incentives are definitely lower. Definitely, your incentive to expand are much lower, that's for sure.
Stanford is a perfect example. I spent a little bit of time in the archives and some of the historical records of Stanford, which is a fantastic school, don't get me wrong. It was quite proud to be regarded as a football school for the early part of its history. And this move into science and technology is related to World War II efforts, related to the big science push, and related, of course, to the overall expansion of the corporate sector around Silicon Valley. But that is, I think, to your point, Thomas, one of the exceptions that proves the rule. That it's a hard market to break into. Now, and one of the really interesting ideas that's out there, Atif, and I hope we can talk a bit about some of the, forward-looking policy that's on the table, because there's a lot on the table. Ro Khanna, who's the member of the House of Representatives from Silicon Valley, actually, is proposing what he calls a Federal Institute of Technology initiative, which would be a lot of federal money to go into exactly beefing up engineering schools in a sort of, in a partnership between the federal government and those universities. And I haven't run that one by Mariana, but it seems like a totally feasible attempt to try and scale up. And then in Thomas, I think you would say to them, look, guys, you don't have to participate, but your competitors are taking a big chunk of federal money. They're going to expand into these new fields. Do you want to play in that or not? I think that's how you jumpstart the university sector.
Simon, just to pick on that idea and also to loop it with what Thomas was saying, let's say you set this up, FIT or whatever you want to call it. How would you design the allocation of those resources? Because you don't want to give it to MIT, if I go back to your example, because the MIT is basically what Thomas was saying. They are just enjoying the riches that they already have. So you want to presumably give it to the next guy or even the university below. So how would you, and there's stuff in your book about kind of evening the regional imbalance, right? So to move away from the coast and maybe give more to places in Ohio and set up new tech centers or universities there. So just say something on how you would design, let's say you get a pot of money to kind of jumpstart. How would you allocate it across the US?
Well, I think that's a great question, Atif. And this was our publisher, Thomas, made us put a map in. We were very hesitant and reluctant, dragged on our feet, but it's the best part of the book because it gives you this visual sense, Atif, that if you sort of take any, and we also made an interactive website, which is called jumpstartingamerica.com, where you can play with the criteria. So you might say, well, Gruber and Johnson, they're interested maybe on something, but I don't believe their criteria. Let me make my own criteria for what it would be to be a next generation tech hub. Whatever criteria you put in, you find a lot of places around the US that have, good universities. They have lots of talented people. They have some, a good standard of living and quality of life. You pick the criteria. And I think that's a key thing about the US, Atif, that not all countries have. We have this deep pool of talent that isn't fully connected and doesn't plug in as much currently to those innovation opportunities. So I run it through my answer to the Mazzucato puzzle, which I saw people grappling with this in the Q&A. How do you put the money into play without it getting massively captured? Have a big, transparent, open competition in which you're getting places to bid to become next generation hubs, and have them somewhat specialized in particular sectors. I mean, there's a very interesting Enrico Moretti dimension, if people are familiar with his book, The New Geography of Jobs, which is, we know there's value to clustering scientists by subfield, definitely a lot of value. Okay, so how do we marry that with the idea that we want to develop these new hubs and we want to spread it around? There is a local regional economic development piece and a science tech piece, and getting those two things, that is not trivial. I can tell you spend a lot of time talking to governmental people, including incoming people, about ways that you can legitimately, transparently, in a way with reasonable governance, get those two things to work together. But I think partly because of Thomas's work and longer rooted concerns about productivity growth, Atif, that there's a great willingness to try this and to try and put more money into R&D and spread it around in some fashion. Exactly what the fashion is will be, no doubt, a political compromise.
I think that, I mean, broadly speaking, if you look at, and not just in the US, even if you broaden the spectrum here, there's clearly a movement towards thinking about place-based policies, which for a long time didn't really have a good name, because they were linked to capture or corruption and sometimes just inefficiency, which is you try to create something somewhere that this shouldn't be there, and so it just never fits and it ends up wasting money. And so there were the idea of having policies that are geared towards local economic development as a strategic goal. They had a bad rep, and they were a little bit given up to some extent in many countries. And I think we are coming back a little bit on that for two main reasons. I think one has to do with the fact that there are limits to redistribution in the classic sense, which is, at the end of the day, people want to live in a place they like and they want to have a job. And the idea that we can just say, oh, let's kind of let that place go to hell and we just write you a big check every month, the idea that this is going to compensate is just not fully true, and we've reached the limit of that. So at some point, it just becomes inefficient to try to compensate losers by just writing checks. It's better to try to develop locally. So we've hit a constraint there, which I think explains part of the shift towards reconsidering the opportunity to have place-based policy. The other reason, I think, is that the extent of polarization has also increased a lot over time. So in the past, it might have been the case that even if you didn't really proactively do anything about places, the balance, the geographical balance was not too bad. Although if you're on the market outcome in the cross-section of region or counties was not too extreme. So even if you didn't do too much, it was not that bad. Today, it seems that without some intervention, we go towards very extreme polarization across locations. And so that has increased the value. So I think what happened is really the market outcome becoming more and more polarized has increased the value of doing something. And on the other hand, the usefulness of other tools have reached like decreasing returns. So the two together means that it's not a guarantee we're going to succeed, but it's definitely a guarantee that every government around the world today is looking at it.
Yeah, Simon, I want to a lot of talent. This comes out of Raj Chetty's work, of course, which is to a degree that we previously wouldn't have fully understood, Atif, where you were born has this big effect, and what's going on in the town where you're born, that has a big effect on your lifetime capabilities and outcomes, including how innovative you are, right? So there's a stickiness to the cross-generational human capital or something. And so that's part of Thomas's point about, you know, redistribution is not enough. Or if you want to be very, you know, even if we don't want to get political, Thomas, let's just say, hey, we need more productivity growth. We want larger output, then we can do things with that. And we are leaving talent on the sidelines by hyper-concentrating in a few places that are very expensive to break into, right? Very, very hard to break into the housing market in San Francisco.
But does it make the fact that this variance is increasing across space, as Thomas pointed out, as well as it is combined with a polarization in politics as well? So what that means is that the places where you're trying to invest more are also politically now more and more different from the places that in effect will be investing in those places. So I mean, there is a political tension here, if you will, that's also increasing. I mean, you can look at it in different ways. You can say this is maybe the Democrat strategic way of just turning these places blue. And so you will get a political pushback, even though you're trying to do something that, you know, is driven by the economics of agglomeration and things of that sort.
Yeah, this is a very good sort of background framing, Atif, but here's some other things to add. First of all, everyone wants good jobs, right? Everyone is worried that their sectors are going to get wiped out by whatever comes next. So Richard Shelby, who is a conservative Republican, he's the chair of the outgoing chair of the Senate Appropriations Committee. He has been a major proponent of science and investment technology in his state, Alabama. Huntsville, Alabama, by the way, a historical note, was the place where they produced the Saturn rocket for the Apollo program, based on German technology developed during World War II, by the way. So, you know, there are many strands that come together, Atif, but the thing that people worry about the most is what happens to my jobs? What happens to the jobs in our community? And can we assure ourselves of a better economic future by making sure that we participate in whatever's coming next? So we find, when I talk to governors about this, or mayors, I actually often don't know and don't bother to look up which party they're from, because it's of no consequence whatsoever for the conversation. Not in the Midwest anyway, and in most of the rest of the country. I mean, I might know what party they're from, but that doesn't affect the conversation. It's all about, okay, what's a good use of our public money? How do we make sure this doesn't get wasted? Do we, you know, what else is going on in the competitive landscape? And people are also really tired, Atif, of giving away tax breaks to companies. I mean, this was a piece of Thomas's story that he didn't mention today, which is, you know, we give people a lot of tax breaks to come to places where they would have gone anyway. They're just to transfer their profits. And Thomas has shown me it doesn't even boost investment on the aggregate. I mean, what's the point of that as a public policy? If you just took, the state spent about $50 billion a year on those tax breaks. If you just took that, Atif, and put it into R&D, okay, a big if, that would have presumably a much bigger effect than what it has now, which is close to zero.
Yeah,
so Simon, the jump starting America can solve the big political gridlock. I mean, I think that's another way to pitch your book, perhaps. It's a very interesting angle. I think it might be the only thing where you can go bipartisan, given what you just said. That's a very interesting thought.
There is bipartisan support for beefing up R&D and spreading around the country, Chief. That I'm absolutely sure, based on personal conversations. What plays out, you know, in terms of what people vote for in Congress is, of course, a slightly different matter. But the idea that, as somebody was asking Mariana, I think you were, about China and about our international competition, if we don't invest in science, if we don't push forward on the frontier, who gets more of the jobs in the sectors that have not yet been created? What happened in satellite industries? What happened in human genome or genomics industry? What's going to happen in the next wave of diagnostics, for example? You know, I think you want to be at the forefront with the crazy scientists and the mad engineers, because they create the spin-off knowledge that gets captured by people who are close to them geographically, right? How close you have to be is a good question. And that then becomes companies, and that's then snapping at the heels of Thomas's incumbents. I think, at least, it's an attempt to do that.
I think that there's two things that are also important here. One is so one thing that's difficult to deal with is the notion of competition between jurisdictions. So, you know, one of the reasons the states spend so much on subsidies is because the elasticity of substitution between states is very high. So, you know, if I give you a break, I might get you to come to my state. So on that margin, spending money actually works. The problem is that in the aggregate, the impact it has overall on boosting your own capex, that's much lower. And so in such a world, like competition between jurisdiction can lead to too many subsidies, which is why in Europe you have strong rules on state aids. I mean, the most stringent rules in Europe by far are the state aid rules. They are the ones that are the most deeply rooted in the EU. And it's precisely to try to avoid that. Of course, it doesn't work fully, I mean, but it removes a lot of it. And it's really the idea that at the margin, it's inefficient for everybody to try to, beggar their neighbors. So I think that's the first thing. The reason to be optimistic to some extent also, on the other hand, I would say, is that, we are not in a normal economy now. We are post-COVID. Post-COVID, people have changed their belief about many things. And the two main ones are science and climate change. So with respect to science, they see that whether or not you have, you are, either you have them at home or you're directly well integrated into countries that have access to the vaccine, that makes a huge difference. And so you don't want to be left behind in terms of technology. And so that I think is going to be a big factor. It's going to be much easier to justify the fact that, yes, you do want to be at the forefront of technology. You don't have to be every country in every domain at the top, but you want to be at least connected to the best ones. That argument is much easier to make now. And the second one, with the biggest change that we're going to have to deal in our lifetime, of course, is climate change. And now the one thing that's striking the discussion is seeing what disruption COVID can create. Now people have it becomes much more concrete to imagine what severe disruption from climate change could look like. And therefore, I think that discussion is also going to change. And if you think in terms of investment and R&D, this dwarfs everything else, because what's needed there is gigantic. And it's also going to be partly public, partly private. So they're going to be public money, they're going to be private money. It's going to be based on prices. So we're going to have to price correctly the risk and the cost of climate change via carbon, via other features. But that's where the action is going to take place. But my sense from discussing and listening with policymakers around the world is that discussion is easier today than it was before, actually.
So let me add a third dimension. I think that's a very good statement, Thomas. Let me add a third dimension, which is I think global interconnections are now being seen in a different way. And a concrete example, Atif, would be an idea from Michael Minna, who's a professor at Harvard School of Public Health, called the Global Immune Observatory, which is a very simple one. On the basis of existing technology, you could build a more or less real-time surveillance system to watch for the development of pathogens, let's say respiratory pathogens, but you can also look at other pathogens through antibody tests, specifically dried blood spot antibody tests. So what you could do with this, Thomas, is exactly, connect the science with the way in which climate or other shocks around the world are causing these diseases to develop and then spread coming at us, Atif, gives you early warning. Is it 24 hours or 24 days? I don't know, but it would certainly be helpful. And it was something that was completely missing, obviously, early in this pandemic. And you could build a lot of other capabilities around this. Think of this as radar for diseases, Atif. Right. And so what did the US wake up to in World War II? It was actually the value of technology for war. That was not a widely accepted or deeply ingrained view in the US military or even in the Navy, for example. They learned that the hard way in 1941, 1942, and they never forgot. Okay. Now we need to take that same kind of lesson, I would suggest, and say, okay, we need a global immune observatory now. Who's going to pay for that? What's the structure? What's the public-private partnership? What's the contract? How do you get a return on capital, but not too much return on capital? How do you feed that into vaccine development or other downstream pieces? That's to be determined. But I think that's actually much cheaper, Thomas, than climate change, dealing with climate change, building that. You could do an incredible effort for $100 million right now. But I think I think Thomas is right, that our sense of priorities and our sense of opportunities, but opportunities as in, my God, we've got to do this, that has shifted. And we haven't fully absorbed that yet because we're still in the somewhat tumultuous phase of the pandemic.
Jamal, let me come to sort of the very interesting graph that you showed towards the end. It's a very strong suggestive link, of course, between the rise in concentration and this increase in this investment gap that you are highlighting. Let's take it at face value and say, okay, this is the rise in concentration kind of causing this lack of investment in at least those sectors by those firms. The question that I have is, how should we think of the rise in concentration in at least those sectors that you highlighted? Is it this sort of hard play by the market leaders to, to basically weed out the competition, and so we just need the usual antitrust policies, just need to impose those rules so they cannot do that? Or is it something about the nature of those industries? So, like think AI and Tesla, for example. If I am the first one that starts getting data on all these drivers and all the millions of miles, I naturally build a comparative advantage with the next competitor, because my AI system will be more efficient because it just has more market power. I see more miles, people drive more miles, I get more efficient on it. Similarly, you can think of, obviously Microsoft was the earlier example, but if other people are using my platform, I have an inherent built-in advantage. So the question basically that I have for you is that how should we as academics or policymakers think of the rise in concentration? Is it something inevitable given the nature of these new technologies that we just need to kind of take it as given that there is only going to be one monopoly at the end of the day and then just deal with that problem that way? Or is it something more the old-fashioned way that we can kind of, just promote more competition? Like if there's going to be one player, that's kind of the efficient solution in a way, then let's not even try to have 10 market players because there's only going to be one at the end, and let's just sort of, regulate the market some other way. So how do you think of this rise in concentration as to its sort of fundamental drivers?
Well, I mean, so of course, as economists, we use concentration as a shorthand, but the first thing to say is obviously that the concentration you see is the equilibrium in the market. So it's not a primitive, it's in the outcome. So I think you have there's two main reasons for concentration. You have either barriers to entry, or you have a change in the technology such that only the really big ones can be efficient. And as usual, I think we see a bit of both in the data. But I would submit two things. First, it's not just the high-tech sector. I think the most outrageous sector in the US is the telecom one. The most outrageous sector is like, internet provision at home. Like how much you have to pay Comcast in Washington, DC to get basic internet services is a national disgrace. It is literally a disgrace. Like there is no other country in the world where people have to pay so much. And the same goes with cell phones. And that's not high-tech stuff. Like this is by today's standard, everybody is doing the same, every country in the world, So even forgetting completely about the 5G debate, which is another separate issue. But I think that this is like very basic market regulation that has failed in the US and has to a large extent succeeded in other countries. So there it's kind of pretty straightforward. And then I would also submit that there's quite a few industries in the US that look like the old-fashioned case where you could do a lot of improvement if you made them more competitive in energy, in transport, and in telecoms, just the old-fashioned way. Once you've done that, you're still gonna have the issue of the super high-tech sector where there is a winner-take-all effect. There are network effects, and there are also economies of scope where if you're really good at AI, you can branch out in other dimension, which means that there might be a natural reason why we're going to have few players. But there, I really think that we shouldn't be too pessimistic in the sense that there is no natural monopoly. You could have a natural duopoly, perhaps, but I don't think our economies are plenty large enough that we can easily sustain 2 or 3 firms, especially if we leverage global competition, because competition doesn't have to come from home. So I think that on a technological basis, I think there is no reason to think that we're going to be stuck with monopolies. Might happen in a few cases, in which case you probably have to switch to the regulated utility business model. But I don't think that's the future for us. I think there is scope for having just like a couple of large competitors. And honestly, the car industry is perfect. I mean, if there is one industry where I am not at all worried about competition, it's the car industry. Like the competition between the German manufacturers and Tesla and is fierce and is only going to become fiercer. And in fact, Tesla is fantastic because it's just, it created such a huge turmoil in Germany that finally they're waking up and trying to innovate again. You know, Germans have spent the past 20 years making sure that when you slam the door of a German car, it's a nice stomp, as if it was like the future of like, and yeah, it's true. Like every fine detail inside is perfect. And they thought that was the ultimate innovation. And now they are completely amazed to see that people in Germany don't care. They're happy to drive a Tesla where the door is a bit ajar, it doesn't close very well, but they love the technology, okay? So that's a kind of, this would not have happened if we didn't have global trade and this competitive pressure. But I think they're gonna catch up. They're not going to, you know, let Tesla run away. Tesla is still gonna be the leader. I think by now, actually presumably because of the data, not so much the battery. The battery people can catch up, but they are getting so much better at the self-driving that, yeah, probably they're gonna remain on top. But I think, so that's gonna be competitive, you know. And I think we can do that in most of these industries, including search, including social networks.
Simon?
So I agree with Thomas on the technology point in general, but can I push a little bit more on the AI, Atif, mostly because I don't know the answer. But if it's the case, Thomas, that what I need to improve my algorithm is more data, and the more the people drive my cars, the more data I get, therefore my algorithm gets better. Isn't it possible that I build an advantage, that the largest you know, early operators and accumulators of high quality data build an advantage that is very hard for others to catch up on?
Yeah, I think that's why Tesla's market value is equal to the market value of the next 8 guys together. It's exactly for that reason. So it's going to be but it's really mean the other guys are going to have to spend a lot of money to catch up. And I think that there's still decreasing return at some point in these things. In other words, data is great, but it's more the way you process the data that really matters. Plus, you have some companies that can sell the solution to different platforms, so you can aggregate. If you yourself is too small to have enough data compared to Tesla, why don't you team up with 3 other guys? They've been doing it for years. That they develop platforms for cars now in common. Most of the cars we drive, they share a common platform, and then you just change the top. So I think there's plenty. My point is there are plenty of technological solutions that suggest that we are not condemned to a world of pure monopolies. We are probably in a world of oligopolies. But oligopolies can compete.
Simon, let me, an issue Tamar raised on global competition. Again, given what Mariana was saying earlier and some of the other kind of regional hubs and so on, there's partly a sense of industrial policy, and even sort of Biden administration has talked about kind of thinking about the supply chain and bringing some of them back home to the US. So there is, at some level, this talk of building some kind of barriers to global competition. And you know, in different ways, maybe not in the standard tariffs ways, but in different ways through industrial policy and so on. Given your experience, I mean, you know, I should have mentioned you were chief economist at the IMF as well. So given your kind of global exposure on these issues, how do you see the political winds shift globally, and what is your take on the nature of global competition? Are we going to see more inward-looking policies, and how do you see kind of the net impact of that? Positive or negative?
One corollary, I think, of something Thomas already said, Atif, about climate change is thinking about resilience and thinking about what kinds of shocks may hit us. And you know, I was involved in bringing PPE to the US, as were all kinds of other strange people, in March of last year. And we were very lucky in the US that the Chinese early pandemic phase ended when it did, because if it had lasted another month, it would have been much, much harder to get masks and gloves and gowns to the US. And that makes you think, okay, what are the sectors that I need to have close by and not prone to supply or any other disruption? And I think that, I don't know the answer, and people are still working on that, but I do think that is one dimension of, you can call it industrial policy, you can call it resilience policy, you can call it climate change mitigation strategy. And then I think there's going to be questions about, you know, which of the countries that are big enough to think in those terms and which ones need to pool some resources. I mean, the Europeans had plenty of friction among themselves about who would trade what kind of PPE in the height of the pandemic, right? So, and those are countries that union is based on the premise of common economic security. So that makes us pause and think about that. So I think there's a resilience factor, Atif, but you have to put that alongside Thomas's concerns about competition. I don't think making our domestic markets more competitive, more protected, is necessarily going to help us on the competition front. And if competition matters for investments and jobs, which it does, we have to weigh that as well. I do think, I would not call this industrial policy, although some people would. I do think this, the push for more public R&D and to try and be strategic and to try and boost sectors and to try and shape sectors. Human Genome Project, you know, it costs you some tens of millions of dollars. In the end, you get an industry out that not only employs 250,000 people and a lot of really good jobs, but it saves you. The diagnostics that were used for COVID at scale in the United States have come primarily from labs that were scaled up by NIH's RADx program that were, I think without exception, genomics labs. That came from, and it was like 1940, 1941. There was an industry that could pivot to do something different, related but different. And then the question is, okay, where do we go with that? Do we build a new industry based on that? How do we think about investing in scientific capability? And I don't want to put Thomas on the spot or make any French people feel at all uncomfortable, but the Pasteur Institute and Sanofi had some disappointments in the vaccine development race, which I'm sure will just cause a redoubling of efforts on all sides to do this better in the future. Thank goodness some other companies got luckier. And I think this kind of competition between countries and jurisdictions is win-win, Atif. So that we should definitely feel good about and encourage.
Great.
Thomas, on this concentration thing, what policies do you favor on that? I mean, you can talk about tax policy. Is that something that you think can be used to get at this problem, or what would be your first order kind of solutions to think about for the US?
Well, I think it's industry by industry. I think that by and large, it's about reducing barriers to entry or cost of entry. I think that's the first order of business. So
you mentioned telecommunication. If you could like,
yeah, I think in telecom, it's really a question of how do you improve the threat of entry. In the telecom, like every country that's been successful at making its telecom industry very competitive, it's been done through some form of entry. So of course, now exactly how you do it is different for cell phone services and for wired cable at home. Like for cable, you have the old-fashioned way. There's only one cable, but then you need to make sure that there's a way of splitting up so that more than one provider can compete to bid up access. And so that's a local regulation issue. That's completely at the state level, and that the state have been extremely bad at doing it. And when they haven't been bad at doing it, they've been pretty much sometimes sued by the private sector for trying it. So that's why, I mean, you end up in a situation where some municipalities in the US are like thinking of developing their own network so that they could get a decent, broadband internet at a decent price. And you're like, this is insane. Like in Europe, nobody does that. Like we don't think, we just make sure that there's competition. So the state does not build, but the state makes sure that, the access, the last mile or the last cable is more or less competitive. And so there are ways to do it. It's not like rocket science, and it's done pretty much in every country. So there, I would just, if you for the cell phone market, that's harder because that's national. There is no reason, you can't enter locally. So then the notion of entry is different. If it's like a transport, well, we'll see, because airlines now, of course, they are in a different state. But pre-COVID, clearly there was need for more competition in airlines. Now, post-COVID, we'll see. So I think you could go through the list like that, and many of them, I think the solution is not rocket science, and it doesn't require you to drastically change the way you do antitrust. And when you get, of course, to the last issue, which is dealing with Google, Facebook, Apple, and co., then it is true that you need to revamp a bit the toolbox, not so much in spirit. So I don't really think we need necessarily to have a complete U-turn on basic notion of consumer welfare and stuff like that. But we just need to be a bit more creative and also a bit less risk averse. So at the end of the day, I think the true constraint, if you ask me deep down, the true constraint in the US are two. One is the regulator became way too risk averse in the sense that they would only bring cases they were sure to win. And because the backlash when they brought a case and they lost it was terrible. So I think that's like a design political support incentive issue. So now it looks like what they are trying right now with Google and Facebook is pretty aggressive. So that means that if they feel political support, then they are willing to take risks. And I think that's good. The second big thing is what judges are going to do. And because in the US, the judge comes first. In the EU, the judge comes second. You can have the commission can decide something. And then if the company is not happy, of course, it can appeal. But the commission can move first. Now in the US, the judge comes first. So you need to be able to make sure that you can convince judges to do something. That is probably, in my mind, that's going to be the sticky point. That's going to be the hardest part because that's very slow moving. So I think that's where the action is going to be.
Thanks. Simon, we have a question from one of our undergraduates, Tiger Gao, that I'm going to pitch to you. And the question basically is, some of the, we talk about climate and some of the other bigger picture problems, they require a lot of very patient capital. You need maybe 10 years of investment and you try a bunch of things, some of that risky, but one thing that is successful then gives huge dividends after a decade or so. And the question basically is that the private sector is just not built for this kind of stuff, right? I mean, even if you think of the most patient capital is venture capital, but even there they say, okay, after 7 years, you need to give me the exit. And so the question is it fundamentally not possible for the private sector, given the way it's structured? And as I said, even the most patient one may not be well structured for the bigger problems that we have, that the only way to kind of channel the solutions to these problems is through the public sector? Is that how you would frame it? Or you have more hope for the private sector to answer some of these bigger climate change kind of problems as well?
Look, I think the private sector operates in a framework created by the public sector. Patience is one issue. Being able to appropriate returns, Atif, as you know, is another. So that if I create general knowledge and with big spillover effects, I and my investors may not capture the full benefits. So the Human Genome Project was initially pitched to private investors, and it's well documented. They said, okay, great idea, but how are we going to get the return? So it became a public investment project that has the success of which has spawned a lot of private sector innovation, much of which we benefit from directly, and as I said, also in the COVID, the fight against COVID. So I think it's about the complementarity and finding that balance, and using the public sector to lower the barriers to entry, Thomas's point, and to bring more competition to incumbents. So I don't think you want to favor incumbents. I think you want to help create new companies and bring more competitive pressure and bring technology that can, to some degree, among other things, bypass existing monopolies or oligopolies. So I think that balance, Atif, is fairly clear. I would caution, and this again, I mean, many experiences about this, including my own personal experiences in the last year of fighting COVID. Government capabilities below the federal level are quite limited in this country. And I can take you through some chapters and verse on that. And at the federal level, there are some very dramatically different philosophies, as you know, about what government can and should do. And it's pretty easy to hollow out the federal government and to encourage a lot of talented people to leave, and quite difficult to build that capacity up again and use that in a way that's really going to be productive. So, and I can't imagine that we're done with swings in the political pendulum. So those are important constraining factors on any thinking in this space.
But I don't think you should be too pessimistic on the idea that we don't have enough patient capital. I mean, the interest rates tell you that there's a lot of patient capital ready, and I think that if you get the price right, that is, if you price carbon correctly, the markets are going to be definitely part of the solution, and in fact maybe most of the solution. It could still make the point that like the government should do two things: it should fund R&D that can provide substitution possibilities away from fossil fuel and stuff like that, but also just getting the price of carbon right. I mean, think about what happened over the past year. I mean, there's one company in the US, and only one, that has been in the top 10 of the top market valuation in US since World War II, right? If you imagine, you make the list of the top 10 companies by market values every year. There's only one company which is here every year. It's ExxonMobil. You see what happened to ExxonMobil in 1 year? So when the market prices things, prices that these are stranded assets, the violence of the adjustment is orders of magnitude more than what any government would ever dare to do. I mean, the market has no problem wiping out entirely a company if it thinks that it's not going to work or the assets are stranded. And on the flip side, look at the market version of Tesla today. That's a lot of patient money. And we know Tesla is not going to sit on it, at least for the short term. They are going to invest it. So this is going to be put to use, right? So at the end of the day, I'm not too worried about the lack of patient capital. I'm much more worried about getting the price right. But if you don't tell markets that there will be a carbon price, sometime in the future, that's the thing. You don't even have to do it today. But if you don't make it clear that there will be a carbon price consistent with our zero emission goals, together with a bunch of other investments, if you don't tell them that, you won't be priced in and you don't get the markets to work. So I think that's the part that I think is more important.
Thomas, we have a question on your telecom example from Swati Bhatt, and she asks, it's a bit of a pushback. She's saying that France has 4 telecoms, Orange, SFR, Boingos, I maybe not be pronouncing it correctly, and 3, which is roughly comparable to AT&T, Verizon, T-Mobile, and maybe one other. So what does
for the US
mean about more competition? Number of companies seems to be the same in France versus the US.
Well, it turns out, if you look at the history of France, 3 and 4 are actually vastly different. So we used to have 3, and 3 was an oligopoly. So I think, so the short answer is 3 was not enough. When we brought the 4th one, we divided prices by 40%. So Free Mobile entered in 2011. Before that, the other guys, France Telecom, Bouygues, and SFR were already there, and they were colluding. And then prices were high and service was poor. Free Mobile entered in 2011 as a maverick and killed the prices. And since then, we've had a competitive sector. So 3 and 4 are very different. It also suggests that, you know, sheer number of companies might not be always the best proxy. Not every company behaves in the same way. But also you have to compare with the size of the country. I mean, the US is huge. So having only 3 telecom operators for the entire US, if you don't make sure they compete fiercely everywhere, then you are definitely in deep trouble. And these guys, you know, the incentive of T-Mobile to compete fiercely with the 2 other ones now is, I don't think it's that high. They can easily split the market, you know. They can't do it as much as I agree, like in terms of cable and broadband access, they split the market literally by blocks. So like, that's for sure. The telecom guys on the cell phone, they can't do it to the same extent, but they still do it. And at the end, they don't compete very much.
Thanks. So we have our next panel starting in 10 minutes, and we have a short break in between. But this was terrific. I just want to give both of you kind of floor for last thoughts or comments, Simon and Thomas. If you want to, you know, say something, closing arguments, if you will, I'll give both of you a chance. Simon, again, I'll start with you.
So thanks, Atif, for this opportunity, and thanks for the great questions. If anyone would like to take, which I think many of which we touched on along the way, if anyone wants to follow up with me, you can email me, sjohnson@mit.edu. Happy to continue this conversation. I do think policy, Atif, will continue to try and take the points on board, both what you've been talking about, what Thomas has been talking about, a little bit what's in our book. And if people want to learn more about that and debate that along the way, happy to be engaged also. Thank you.
Thank you.
Thanks, Simon.
Nothing to add except don't be too pessimistic. I think we have solutions, and I know there are many young people listening. There is a lot of opportunities and a lot of things to be done. So every challenge is an opportunity, and that's how you should think about it.
Thanks, Thomas. That's a great positive note to close on. I should add that Simon really highlighted something positive that I haven't heard in a while, that there is something we can do in a bipartisan fashion that both people from both parties can agree on. And it appears that might be something on the R&D kind of jobs dimension. And that's a great point, actually. I never fully appreciated it. So thanks again, Thomas and Simon, both for joining us. It's been terrific.